Hello there everyone, today's video is all about the recent Chancellor's Autumn 2021 budget announced just a couple of days ago on Wednesday. Now I've had time to reflect, I want to give you some of the insights into the tax specific measures of that budget. So remember, the budget doubled up as both a budget and an annual, or rather a spending review. The spending review doesn't happen annually. Budgets happen twice a year. There was one in the spring and this one in the autumn. But the spending review, in terms of how the various government departments get allocated their funds, that is more infrequent, but that also doubled up as the announcement this week. But I'm just going to talk on the tax angles. Now, most of the tax announcements this year were in the spring budget. Most of the tax announcements affecting the majority of people. There was also the big change to the dividend tax, the national insurance hike, which comes in from next year, which was announced last month in September as part of the social care levy. I've done separate videos on that. But today we're just going to focus on what was announced, tax measures this week. Now, there were actually, when you look at the devil's always in the detail, not what the Chancellor says when he stands up. You've got to look at the Treasury's Red Book, but also look on HMRC's website as well, which has a lot of interesting tax announcements, the policy papers surrounding the tax changes. A lot of them very obscure, not very relevant to the vast majority of people. Things like taxes on museums and various bits and pieces, which, yes, to those involved, very important, but to the vast majority of people, they're not too concerned. So what I wanted to do today was just take a look at a few of the things that I thought were relevant to a great deal of people. And there wasn't that many things. So let's have a look, see what there was. So first of all, R&D. Now, R&D, as we know, very valuable tax relief for companies only, and it's been around for about 20 years. And what the government announced, they said that they will make it more attractive for businesses in the form of the eligible costs from which you can claim R&D tax relief on will be expanded in scope to include cloud computing and data costs, which is all part of modern research. They will now be allowed, whereas previously cloud-based costs and data were not deemed to be eligible costs for R&D. So now going forward from 2023, they will be allowable, which is good news. However, on the downside is the announcement of a territorial restriction for R&D. Territorial restriction where the government are trying to refocus energies in R&D activities to be in the UK rather than outsourcing abroad. Now, for the life sciences sector, that's a bit of an issue. Reading various articles in the last 48 hours, people have said, well, hang on a minute. A lot of these big life sciences, biosciences who do a lot of R&D outsource it to overseas. They have laboratories in different parts of the world undergoing R&D activities. And currently the UK tax rules say there is no territorial restriction. You can get your R&D, if you're a UK company, expenditure, even if the activity itself is done by an overseas lab. What they're looking to do, what it sounds like they're looking to do is, although they haven't specifically said, is just the Chancellor's been a bit vague and says we look to target more the focus of R&D to the UK economy. So territorial restrictions to possibly come in, no detail on that yet, but watch this space. But certainly for the extension for the applicable costs, cloud computing and data, terrific. A lot of SME businesses who claim R&D will welcome that. Basis period is the next thing. The basis period, and I've done a separate video on this because this was a proposal by the government, a consultation which is now being put on the statute books. It is going to be law, and this is for businesses who are sole traders or partners who have a year end not the 5th of April or 31st of March. So their business year end is not the same as the tax year end. And the government says we will like people who are sole traders or partners to pay the tax on the profits that they make in a tax year, regardless of when their business year end is. So for example, just quickly, if you have a April 2021 business year end, if you're a partnership, that will form the basis of your taxable profits for the 21-22 tax year, even though only 1 month of your trading year is in that year, and the rest of the profits that you make in the rest of the tax year, the next 11 months, won't be taxed until further down the line. So basically, you're always playing catch up. Eventually, you pay obviously the tax that is owed, but it's a deferral mechanism, for want of a better phrase, if you have a year end closer to the start of the tax year. The revenue as a tax raising measure, because they need more money, have said we don't like this, even though they brought that idea in place to begin with when self-assessment came in about 1997. So they said we're going to change the rules. Basis period, you pay your profits, you pay the tax on the profits in the tax year regardless of the business year end. That will affect around about 500,000 sole traders and partners. And looking at the policy papers, which I always like to have a delve into in the government websites, lurking in the corners of HMRC's websites, and they reckon that will bring in £1.5 billion. So £1.5 billion extra for the acceleration of the tax bills of 500,000 sole traders and partners. Next one, capital gains tax. This was a change that came in last year. When you sell residential property in the UK, you have to pay the capital gains tax within 30 days. It used to be that you had till the 31st of January following the end of the tax year of which the sale occurred. So if you made a sale on the 6th of April, then you had until the following 31st of January to pay the tax, which is like 22 months. The revenue said, no, forget 22 months, we want to make it 1 month. However, the practicalities of that, since it's come in, have proved rather difficult for a lot of taxpayers. People haven't been able to get all the information in place. And the revenue said, look, we expect it's not going to be accurate. You can then make good what it should be in your tax return, but give us a best guess estimate. But it still has proved practically difficult for thousands of taxpayers to do a capital gains summary and pay the tax within 30 days of selling their resi property. So the Office of Tax Simplification, who've been in place for about 10 years to advise the government on how to simplify the UK tax code, have said, look lads, get that 30 days up to 60 days. Thankfully, the government listened and said we will do that. So that has now changed. So that is for all residential sales in the UK that complete after the 27th of October. You have 60 days, not 30 days, to pay your capital gains tax bill. If you sold, say, 2 or 3 weeks ago, you don't get another 30 days because it's all about the completion. If you completed after the 27th of October, that's when you get the extra 30 days. So what else? Annual investment allowance. This is the tax relief that you get on buying kit, capital equipment, machinery, plant and equipment. Goes on your balance sheet, but you get immediate tax relief as if it was in your P&L. You get 100% tax write down on the cost of those assets. Annual investment allowance. They announced this week that the £1 million limit will be extended to the 31st of March 2023. So that is very good news indeed, because it was due to come back down to 200,000. They've said, no, we're going to keep it at £1 million for a bit longer. So you've got till March 2023. Now, you may be saying, well, hang on. Forget annual investment allowance. We've now got this thing called the super deduction. The super deduction was brought in the budget earlier this year, the spring budget, where the Chancellor said super deduction trumps the annual investment allowance, because not only do you get 100% immediate tax write-off, you get 130% immediate tax write-off, hence the term super deduction. 130%, no cap, even higher than £1 million, no cap, immediate super deduction against your taxable profits. So you may say, well, why do we care if the annual investment allowance has been increased for a bit longer when we've got the super deduction in any case, which goes on to the same date? Well, it's because of the types of assets that apply to both, because they're not the same. Under the super deduction, you have to buy brand new equipment. It can't be secondhand. You buy it brand new, and then you get your 130% tax relief. Now, you may not want to buy something brand new. If you've got a choice economically, you may got to weigh up the cost versus the fact you're going to get 130%. But let's say you don't want to buy a brand new piece of equipment. You've seen a second-hand forklift truck or a second-hand bit of machinery, and you want to buy it. Yes, it's new to you, but it's still second-hand. That's when the annual allowance kicks in, not the super deduction. So you can have the annual allowance. So you can't have both on the same asset, but for certain assets, you choose. You say, well, have the super deduction on that and the annual investment on that. You would, most cases, you choose to have the super deduction if it's brand new. But of course, if it is second-hand, you can't have the super deduction, and instead you have the annual investment allowance. So, but both of these in play together, very generous. Finally, just made a note on the dividends, which I said at the top of the video, announced in the social care levy in September. 1.25% increase in national insurance from next year also applies to dividends. They reckon, again, reading the government's papers on this in the last 48 hours, they reckon there's about 2.5 million individuals, business owners who pay themselves dividends from their own company. 2.5 million. They will be affected by this hike in the dividend tax. An extra 1.25% on top of the existing rate, so 7.5% at the basic rate and 33% in the higher rate. That's going to be going up by 1.25%. So that's just an overview there on some of the tax highlights in the budget, which was light on tax announcements, really. There wasn't a great deal, but nevertheless, something there which I'm sure will be of concern, of interest and relevance to a great deal of taxpayers. So if you like this video, please do subscribe right there, and I'll see you soon.